Welcome to Towson Asset Management's Capital Markets Review 2020. My name is James Tarkenton, and I'm the Senior Portfolio Manager. We're going to talk about where we are right now. We're going to talk about the economy, the Fed, bonds, stocks, an expectation of increased volatility, how you cannot time the market, and we'll finish with some numbers about past elections, given where we are in this election cycle. So we are currently in the longest economic expansion measured by GDP ever, over 11 years. But length, in and of itself doesn't necessarily mean that it has to end. And I guess one of the questions is, how did we get here? How did this long economic cycle, what was the support to it? And here we have quarterly GDP growth. And one thing I want you to notice is on the far right side, you see that the average GDP growth over this cycle has been about 2.3%. Compared to the historical average of 2.8. But if you just look at some of the past cycles, when there's been a large drawdown, there's typically a large spike in one of the quarters of GDP. And while we have, I would call, smaller spikes here, for the most part, it's been a very slow but consistent, 2% plus growth. And so while it hasn't, been, extremely exciting, it's been very consistent. And I think that has been really the backdrop to a record economic expansion. Here's the Treasury yield curve from last year to this year. Last year being the orange or yellow line, and this year being the blue line. And having this meeting a year ago, I don't think anybody would have predicted this. And as we sit here recording this on March 3rd, this has declined even more. But how did we get here? Arguably a sign of lower rates is a concern for growth as investors look for safe haven investments. And with bonds, as price goes up, the yield goes down. And so more and more money is coming into the Treasury markets, the bond markets, that's pushing down yields. Those are arguably safe haven investments. So the general mentality is that there's concern for forward growth. That being said, this is an environment where capital costs are low. And also an environment like this explains where some of the multiples are on the equity side of the world or the stocks side of the world. This is just a historical view of the 10-year in blue, the 2-year in yellow. You see the spread there of 133 versus 116. So we still, we do have, what would be considered a traditional yield curve in which, longer term money is, costing more than shorter term. That being said, the spread is tight. We did have an inverted curve at one point during last year where the 10-year was below the 2-year. The reason that's relevant and why it's somewhat of a concern today is, that has been used as a predictor of past recessions. That being said, the comment is that the inverted yield curve has predicted 5 of the last 2 recessions. So it's something to pay attention to. An inverted yield curve would have to be present for a number of months and include some other factors to really gain confidence that, we need to be paying attention to some type of recessionary concern or risk. This is simply nothing more than kind of a review of what the Fed's done over the last 15 years plus. Ironically, here on March 3rd, again on this recording, we could lower this another 50 basis points as the Fed has stepped in today to cut rates I'd say unexpectedly, but certainly the market's been talking about it the past week and a half. and they came through today with a 50 basis point or a 0.5% cut in the rate. Market today is trying to figure out what that means as it continues to gyrate positive and negative around that announcement. But you know, the Fed uses this rate to manage two things, and that's employment and inflation. So let's see how they do, or how they've done. Here we have unemployment, which is inverted and is the blue line. That's why it actually is going up as it is lowering. So it's an inverted unemployment rate, and wage growth. And you see that we're basically at a historic lows of unemployment, and that historically comes with wage pressure, i.e. inflation, need for greater rates or increasing rates. Well, you can see that wage growth has not been a large of a push on inflation lately, or in this cycle. I think a lot of that has to do with higher productivity and underemployment, where those that are employed or not employed or in roles that you know, they feel they have the power to go and negotiate for higher salaries because they can't find necessarily the employment they're looking for their true skill set, et cetera. So then inflation. So this is consumer price index. That is the blue line. The core consumer price index, which is in, I'll call it red, that excludes food and energy. I understand that's volatile, but I don't know about you. I have to buy food and gas. So, you know, I think the true price index, either of them shows that inflation's been pretty managed well over this cycle. And so I would argue that if you think about what the Fed's role is in managing the economy through employment and inflation, that they've done a pretty good job. Wanted to just quickly show this. This has been the first time this has ever occurred in which the Federal Reserve is using its balance sheet, buying agency paper, mortgage-backed securities, treasuries, et cetera, arguably keeping the money in our pockets to go do other things with, and increasing, you know, their balance sheet doing so. Now this has also effectively been an easing lever that they've used. So an argument could be that actual rates could stay low, and the Fed could effectively tighten by letting this paper roll off their balance sheet and not repurchasing. And so going forward, you know, the Fed kind of has, you know, different ways in which they can manage needing to tighten should we start to see a pickup in economic factors. And we're not the only ones doing it. This is just a picture of kind of global central bank balance sheets, which have also grown over the near term, or recent term, I should say. So going into bonds, these are U.S. corporate bond yields, AAA to CCC. Anything below a BBB is non-investment grade. So if you're looking for yield and you don't think 2.1% is worth your money for a AAA rated issuer, and you want to step to BB and accept greatly higher default risk, you'll get paid 1.7% for that. So arguably these spreads are pretty tight. And I think interestingly, there may be a chance that we don't even have a AAA interest rate sometime in the near future, as there's only two companies that are rated AAA. And for trivia for your next dinner party, that would be Microsoft and Johnson & Johnson, the only two AAA rated companies in the US. Basic point here is that spreads are tight, and as you increase your default risk, you know, it's a real measure of if you're getting paid for that. But there are dollars being allocated to these lower tranche bonds because there's nowhere else to get yield unless you want to go invest in the equity markets, which has been a strategy recently. So this is high yield. This is the spread relative to the 10-year in blue. Again, it's an argument of stretching for yield, which the spread is below the average, and trying to earn income. The Fed is forcing traditional bondholders to consider equities, pushing up valuations and supporting risky asset valuation prices in an environment like this. So moving to stocks, this is the S&P 500 since January 2016. This data is through February 26th. So leading into our seminar last week, we did start to pick up some of the downturn that we've recently experienced. As we look at the markets here at Townsend, we often, get a question, how do you know whether it's undervalued or overvalued, or, if it's priced adequately where it is? And, the market comes down to earnings. Earnings drives market prices. And so if you're evaluating the market at any given time, what are their earnings and what's the valuation? And so here we have the S&P earnings per share on the right and the index on the left. So the blue shaded is earnings over this time period, and the blue line is the index. And I would argue to you that the market earnings have caught up to the price. And so I would say this would suggest that the market's kind of fairly valued. Why have we had such an extended period of market growth or price growth? Well, arguably the earnings have been significantly higher than where the market was pricing those earnings. You can see this evidence by just looking back in 2000, and you see the gap between the market price and the earnings there during the tech bubble peak. All you had to do was see where the earnings were, where the market was pricing those earnings. You could see that it was extended back in that time period. And so while, we've had the 2019 was a 30% up year, if you look at this graph and near, the 2020 horizontal line here, you come back to basically the beginning of 2019. Well, that 30% is really priced off of where we were on January 1st, 2019, and it was near the bottom of the market for those that can remember the fourth quarter of 2018. Its basic point is that it's a point in time measurement. If you back this up to early October of 2018, the market's up 15%. Since then, and if you back it up to September, the market's up 10. And so, while being up 30 would suggest that wow, we had a really good year, should we take some money off the table? It's a little different picture depending on where you pick your start date. So then we moved to valuation. So we were looking at earnings growth and the support of the market, and now what are we paying for that? And so clearly, we've got a full market. 19 times, it's not overly expensive, certainly by historical measures, but it's also not cheap by historical measures, looking at the financial crisis low. But now that 19 times is an average, so I feel that we still have the opportunity to find some one-off opportunities, starting with the quality of the business and what it does. Is it a business we want to own? But then as we look at earnings and valuation, while it is harder in this environment, we still are finding opportunities to allocate capital to some equities, but on a selected basis. This slide is just another, probably slightly more complicated way to look at multiples, but the point I wanted to make out of this slide is that 2019 was a pure multiple expansion year, meaning investors basically just paid more for the same level of earnings. And so on the bottom of the chart of the graph, these are various multiples used to evaluate the price of the market at any given time. This is the standard deviations away from the mean. The orange X is last year, or 2018, excuse me. The blue diamond is 2019, or as we sit here today. And you can see that we're almost two standard deviations away from the mean, and you see that the growth from the multiples of last year. 2018 earnings grew 26%, 24, 26%. The market was down 6. 2019 earnings grew 0. The market was up 30. And so if you average that out, you basically end up in equilibrium, which is what the graph showed a few graphs ago, comparing the market to the earnings growth. But with 0 earnings growth and a 30% upside, that explains the multiple expansion, or that shows the multiple expansion. But the U.S. is not the only market in which you can participate in equity markets, and from a very high level, the developed markets and emerging markets are much cheaper. I do caution, though, that because it says developed markets are 15 times earnings, that you go buy a bunch of developed market equities. It wanted to make the point that basically this is just where the rubber starts to hit the road. You're looking at earnings growth, you're looking at multiples, and lower multiples suggest cheaper, higher multiples suggest more expensive. But until you really roll up your sleeves and get underneath the hood, so to speak, that's kind of where you really get to work and start to identify whether, for a developed market equities at this point, is 15 times an accurate multiple. I don't really have a specific answer to that question right now, but obviously I know that 15 times is a little bit cheaper than 19 times. So if we're going to allocate time in finding ideas for our clients on the equity side of the business, we're certainly going to start where things appear to look a little bit cheaper. And so now we're going to get into, I guess, the Townsend 2020 message, and that is the discussion of volatility. This is what's commonly known as the VIX index. It's an index of the options market, puts and calls, and it's a measure of traders' expectations of fear in the market. Obviously, we had planned this seminar for February 26th, which was 27th, which was last Thursday, and looking at the far right of this slide at 27.6%, that was not present when we originally were pulling this data together, and so now it looks like we've just joined the bandwagon. But our point here is that we're not really sure if the average investor understands that market movements that we're having now and have had in the past are normal. We've come from an environment of very low volatility, a very low number of days in a year in which there's a 5% move or even a 3% move or even a 2% move. But it's our belief, given that we're in an environment where right now earnings are expected to grow 5% and the market's priced at 19, we're going to have what appears to be an elevated level of days where there's higher volatility. And our argument is that that's basically just getting back to historical averages. Here we have the blue bar is the annual return for the S&P 500. The red dots are at any given point where the market was. And so if we look at 2019, up 29% from a price standpoint, it was up 31 on a total return standpoint. I don't think it's on the top of investors' minds that at some point during 2019, we were actually down 7. While we finished down 6 in 2018, at some point we were down 20. And I think if you just take a step back and look at this graph, it shows that for the most part, the S&P 500 has had positive annual returns. Every single year that there is a positive return, there was a period in which the market was negative. And so this is something that we would hope our clients would increasingly keep in mind, that this is normal. Here we have the number of days in a given year, calendar year, which there was a 5% pullback. You want to notice that the average is 4.5 times. So on any given day, on average, 4.5 days have a 5% move. And I think relative to near history, you can certainly see it. Even going back to 2012, we really only had 1 year in which that 5% movement in either direction was greater than the average. And it's our expectation that this will be a year in which we're a little bit higher than average as well. So the bottom line is, I think you should expect some increased volatility relative to near-term history, but a move back to normal averages would be our point. These are a couple slides related to being in or out of the market and what that would do to your total return. So this is $1,000 invested over the last 25 years. The green bar is if you invested $1,000 25 years ago on day one and looked at your portfolio 25 years on day last, you'd have about $1,000. But over those 6,250 trading days, if you missed 10 of the best in those days, you would have half your money. So being a good investor doesn't necessarily mean getting out in and out of the market back and forth based on what's happening on a daily, certainly not weekly or even monthly basis. So if you miss the best days in a given market, it's going to affect your total return for sure. Same analysis, but with getting out of the market after a 2% market move or worse, and how long it takes you to get back in. Again, invest $1,000, 25 years, $5,000. I don't know about you, but in my household, it usually takes about a month to make any decision. And if that were the case with my portfolio over this scenario, I would have $1,800 after over 6,000 trading days. So again, need to be mindful of getting in and getting out of the market and your ability to time when to get in and out of the market. Very difficult. You can be lucky in given one decision, but over time, I think you'll find it's a futile exercise. And ending on the news of the day, and not taking any particular one side or the other, just wanted to show some numbers that are on top of clients' minds of being in an election year and what do you do with your portfolio, and that historical analysis would suggest that you don't do anything. So this is presidential elections, Democrat blue, Republican red. In the year of the election, the Democrats have a slightly higher return. That being said, if I think I told you we would get you a 10% return in an election year, you would be pretty pleased. And certainly 1 year after either election, you've got a 12% return on average. So I would argue that elections, regardless of party, really aren't going to affect the attractiveness of the returns and equities that you can earn. And one last one here for non-election years in green, presidential election years in blue, and then midterm elections. Clearly, this does suggest that investors' minds are slightly more at ease when there isn't elections going on, but the returns during elections would suggest that those aren't too terrible either. So wanted to thank you for your time. Tried to be as efficient as I could. If there are any follow-up questions, please don't hesitate to give us a ring here at Townsend at 919-782-9689. I hope you have a great day, and we'll talk to you soon.